And good afternoon, everyone. John Hutchinson with Traders Reserve's Options Income Blueprint. Happy Thursday. I hope everyone is having a great day wherever you happen to be and whatever time zone you happen to be in. We're going to be kicking off here in just a couple of minutes. We have a pretty large crowd expected for our lunchtime training presentation, so please be patient for about the next 60 to 120 seconds while we get underway. And then we will be off and running. I want to make sure that folks who are coming in have enough time to get into the room, get themselves set up, and are ready to go. So as we're getting started here, would like to take a moment to make sure that everything is working here. This is a program that taps into Google Hangouts, so there are from time to time video and or audio difficulties which we are not in control of. So if they do happen, if your screen freezes, if you lose audio, best thing to do is to simply log out and log back in to the webinar, and you'll catch right back up. Now, if you would, just so we can make sure that everybody can hear us okay, just take a moment to type a yes or a Y in the chat box to the right of your screen, and feel free to let us know where you are watching us from. We always enjoy finding out how far around this globe our presentations are actually reaching. So I will give everyone about 60 seconds to let me know that you can hear us okay, and then we'll be getting underway. And I have a special guest whom I will introduce to you in just a moment. But before we get rolling, or as we get rolling, and as everybody starts to let me know that you can hear us okay, then we will start on slide number 1. Looks like we've got some yeses coming in, so far so good. Thank you. And just to get the legal stuff out of the way, if everybody would bear with me, this is obviously a trading strategy, and as part of that, making the lawyers happy, we always read our U.S. government required disclaimer to you. Forex, futures, stock, and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the Options Income Blueprint methodology or the system or the information in this presentation will generate profits or ensure freedom from losses. During this presentation, we will be showing you actual trade recommendations that have been made as part of the Options Income Blueprint program. We'll give you details on that a little bit later, but I'll remind you these are not hypothetical trades. They are actual trades that were made in this program. If you need to read our entire disclaimer, you're welcome to do so at tradersreserve.com or optionsincomeblueprint.com. This webinar presentation is being recorded. You will have access to the recording as soon as we complete this webinar today. So we'll be happy to make sure that you get that link by email as well. We will be inviting you to join the Options Income Blueprint program. As I said, we will give you the details on the program and how to join at the end of this webinar. My guest and I will be sticking around to answer as many questions as you folks have. As we go through the webinar, please feel free to load them up in the chat box. I would remind you, however, in the chat box, please use family language. We just ask that if you would please. So we have folks here from North Carolina and Ohio, and look at this, Maryland, Texas, Rhode Island, Ottawa, welcome Canada, Arizona, Utah, California, New Jersey. Wow, we were all over the place. Daryl from Perth, Australia. Happy day to you, sir. Some more folks from Texas. Steph from Sweden. Welcome, Steph. So, wow, we're really going global here today. Another Toronto, Canada. Illinois. Boy, we're getting about 30 different states here. This is fabulous. And Christian from Switzerland. Welcome, sir. Thank you for upending the currency markets, sir. Just kidding. My special guest today is Michael Schulman. If you don't know Michael, he will do a little bit of his own introduction. Michael is a published author. He is a 30-plus year veteran of the stock markets as a financial analyst, as a financial writer, and as the operator and the mastermind, if you will, behind the strategy that he's going to teach you today. So I will turn this over to you, Michael, and let you get us underway.
Thank you, John, and thanks everybody for coming in the middle of your day. I speak as one of you in addition to speaking to you, so here we go. This will be in 3 parts. There's why you should consider weekly options. This is how you do weekly options. And then we're going to go through some real-world examples that are the most recent from the service itself. So let me ask a question. Are you a trader or an income investor? I assume you are. You're struggling to get consistent income from your portfolio. Are you angry? I think many of us may have been past it, but we're angry about zero yields on bonds, on dividends, on money funds. You're frustrated by losing money buying options and trading options, and you're hungry for a simple way to put more cash into your account consistently. Well, in the next 30 minutes, I'm going to give you a proven strategy you can use to turn every Friday into an extra payday selling options. Now, I've developed a simple to follow, very low risk trading strategy that can, for some of you, restore your retirement while protecting your precious portfolio, put hundreds to perhaps thousands of dollars of cash in your pocket every week, and end the income frustration I just alluded to, turning your income dreams into a reality. And what I'm going to teach you at the most might take 30 minutes a week. Now, those who follow my simple low-risk weekly option strategy, based on an average portfolio size that we see from our surveys, are averaging over $250 per week in total income. Simply put, that's a great extra payday. In just the last 4 weeks, we hit that number. Following my strategy, doing very simple trades, you could have put $250 per week or more with that average portfolio size. That's over $13,000 a year in additional income, and I'll bet you're missing out on it right now. So it's time to change that. But who am I? Who's this guy telling me how much money you're missing out on? I'm 30-year stock market veteran, either as an investor or as an analyst or as a trader, trading my own account. I'm a published author of 2 books, Sell Short and Made in America. I contribute regularly to a whole bunch of very legitimate and well-regarded financial sites such as Seeking Alpha, Microsoft Money, Traders Reserve, and so on. In the last 4 years, through various services, this being one of them, I've helped thousands of income-hungry people such as yourself use the power of selling options to meet, and more often than not, exceeding their income needs. But most importantly, since 2010, I've been helping investors just like you, and in many ways just like me, to master my simple low-risk strategy of selling weekly options. You see, 4 years ago, I had my own income problem. My wife and I have twin sons, and they were about to go off to those really expensive liberal arts colleges you all read about. I discovered I had 2 choices: to take a real hit to my retirement account and hope I could make it up later, or create a simple, repeatable system to put cash in my account regularly without risking that core capital. My target was 0.5 to 1% a week. Every week, mark it up, mark it down. My need for income was not going to be based on the moves in the market. It was going to be based on the real world needs I had. So my solution was selling weekly options. And that's right, I said selling options. Now you're going, hold on a moment, don't run off thinking, oh no, I've lost money with options before. And that's true. Most option buyers do lose money. More than 80% of the time, actually, options expire worthless, which means whoever bought them lost money. But think about it. If the options buyer is losing money, who's making the money? The option seller is making the money. Most option traders speculate by buying options. I don't speculate. I accumulate cash, and lots of it. I sell that speculator risk in return for cash, and option buyers are buying risk, and they give me their cash, and it happens every single week. And here's why when you sell an option, you get what I'm talking about. You get instant cash. You sell an option, it's just like selling anything. The buyer pays you, it's in your account immediately. You're transferring that risk. When you sell an option, the risk is on the buyer, not on you. There's a protection of capital. You have a tactic available that the buyer does not to protect a trade from losing money that week. And simplified trade management. When you sell an option, you're managing money you've already made. The buyer is giving you their cash. It's your money. The buyer is managing risk. So selling options for consistent income is a viable and safe way to put cash in your pocket, even with a target of 0.5% or more a week. And when you learn my simple, repeatable strategy, the consistency of it, you'll be able to enjoy the thrill of giving yourself an extra paycheck every single week. And it's how I and my wife put the 2 kids, the 2 sons, through college, and I'm proud to say they graduated this past year, and I'm also proud to say they're now collecting their own paychecks. Still, you're probably wondering, okay, how hard is it to sell options to generate cash? Let me give you a peek behind the curtain on the how-tos of selling weekly options for extra cash without putting your account at any more risk than buying a stock. Let me make some honest points here. In order to sell an option, you must have the capital on hand as collateral in the unlikely event your put the shares. And to be able to consistent weekly paycheck at a bare minimum, you should be using $10,000 in capital, preferably more. And you can do this in a retirement account. The only place I do this is in my retirement accounts. And the highest premiums and the largest amounts of cash produced occur when you sell an option, not when you use other option strategies, because of the focus on the preservation of capital and the consistency of week-by-week returns. You see, also, for those of you who are experienced with options, selling weekly options are no different than monthly options, except for their duration. And the majority of weekly options do exist for just 1 week, expiring at the end of the week. And there are those that are listed weeks and even months before. But I, in the service, trade those options only in the same week that they expire. Plus, during the third week of every month, the week when monthly options expire, every option, in effect, becomes a weekly option, and that is a very, very good thing. As I said before, more than 80%, and I think it's closer to 85%, of all options do expire worthless, which means the buyer loses all of their money, and the seller, you're keeping all of the money that was instantly put in your account at time of sale. And the value that they have bought, what these buyers are losing, is decay. The value that they bought decays every hour as expiration approaches. Now, another cash benefit to selling options you may not have considered, especially weekly options. When you sell an option and it expires worthless, there's no commission. You pay 0 commission to close out the trade. It's a one-way commission. And that, too, is a very good thing. The bottom line, you should be selling options every single week and racking up extra cash, because as the seller you have these advantages: instant cash, lower risk, fewer commissions. So let's get started with the brief tutorial I alluded to. I'd like you to meet a new friend called time decay. Time decay is the enemy of the options buyer. Time decay is the friend of the option seller. And what time decay is how an option declines in value over time, even if the underlying stock does not move. And time decay, as you might guess, in a weekly option that has such a short shelf life, is ferocious. Now, there are more than 400 weeklies, so there's a large universe of stocks, ETFs, and indices that you can trade. You're not stuck into a narrow range of niche stocks or speculative stocks. These are mostly extremely liquid or big-name stocks. So you also have time decay on your friend, and you have the universe of more than 400 names. Now, when I started doing this, there were only 50. This increases a few every single week. You're also going to be looking for volatility. Here is a chart of General Motors. What do I mean by volatility? I mean the movement of the stock, and therefore the option going up and down and up and down. General Motors, for whatever reason, is a core industrial stock. There's a lot of volatility associated with it. In recent days, as you can see on the right side of the chart, General Motors announced earnings, and the stock did spike, which will create volatility for several days in the future. This volatility, in turn, creates the rich premiums that we want when we're selling the options. You're also looking for liquidity. You're looking where there are a lot of contracts open, and when there's a narrow spread, as it is called, meaning the difference in the bid price to purchase something or the ask price to purchase something. These, of course, would be too low price to sell, but I use this as an example to show that when you have more liquidity, with 1,648 open interest contracts, you have a very, very, very narrow spread. This is important in terms of being efficient when you execute a trade. And the question, of course, one of the last questions mechanically, is looking for the proper day to sell. In the service, I typically sell weeklies in the middle of the week, sometimes on a Tuesday, once in a blue moon on a Thursday, and I also will turn a monthly option, something sold weeks in advance, into a weekly, meaning I close it within 5 or 6 trading days if the stock and the option have moved in such a way as is a terrific profit for us. Now, a larger number of stocks do make their weekly options available several weeks to 3 to 4 months ahead of time for trading, which means in some instances you too can look at a weekly option 2 weeks to 2 months out. But as I said, let me repeat myself, when I trade weeklies, I typically do them that week of expiration, unless there's too much money to be made, as you will see in a minute. There are different ways, there's different flexibility. So sort of the last task when you're creating a weekly option position is to recognize and take best advantage of that flexibility. You can sell weeklies that expire that week. You can sell weeklies that expire any week, as I just showed you. You can close monthlies early. And during the sharp correction that we saw during Congress losing its mind and threatened to renege on the debt in 2011, we closed weekly trades in a day because the profits were so large. So by now you're probably wondering, how does this selling of a weekly option really work? So let me walk you through some recent weekly option trades we did for my Options Income Blueprint members. The company in question is Gilead Sciences. This was a trade we were going to show anyway, but they've been in the news because earnings came out about a little over a day ago. This is the 1-year chart, and you can see how volatile it can move up and down, creating premium, if you pick your timing right, creating premium to sell, let's say, a put against Gilead shares at certain parts of the week when you're selling a weekly option. And they have very, very liquid weekly options. So this trade was put out on January 6th, and it was actually a monthly, but I was considering closing it within a week, which I let people know, and we ended up closing it in a little bit over a week. I'm using this example for those of you who are concerned, well, I want something more than a 2.5-day trade. I want more cash than $30 a contract or $40 a contract. We've emphasized that so far, and we're going to show trades that show you that, but I wanted to show you a trade that lasted a little longer than a week to show you how flexible you can be in using this strategy and this approach. So here's the recap. We sold for $1.75, and since each put contract controls 100 shares, we collected $175 per contract. We transferred the risk. We were not holding this until earnings, which came after the expiration date, and we needed $9,500 in capital. In the unlikely event you're put the shares, if Gilead closed the week below 95, now this does not automatically happen. I've owned stocks that were below the price of the put and not been put the shares. And in our service, we will always move a put. It's called rolling if we need be to avoid that situation. Within a $10,000 account, I would sell one weekly option and generate $175 in cash before commissions. When the option expired worthless, as it did, you had a 1.8% return in capital. This was almost a 2-week trade, but that happened in a 2-week trade. And this is a higher capital required example. We trade stocks as low as $15, which means there's a lower capital requirement per contract. Here's what sort of the screens look like, and it's emphasized, and we could see that it expired. It was a great trade. It was a fun trade, and Gilead's one of our favorite stocks to trade. So the dates themselves, just to give you more of a granular feel for it, and the prices, was trading at $95.50. I follow the stock. It's part of what I call my 25 stock bullpen. And 95 I thought was going to hold. I used short-term support, 3, 5, and 10-day volume flows into the stock to determine these things. So I sold the week 4. We collected that premium. We put up the capital. We didn't spend the capital. It stays in our account, but we put it up. It closed over $100. The trade expired worthless, and the money that we'd collected, we don't have to use for anything else. It stays in our account. Now, this is just one trade and just one contract, so use your imagination about what kind of cash you could generate doing similar trades, perhaps with a larger position. Now, you may be wondering, can you do this every week, at least on a regular basis? Well, this is a question you're asking someone who makes between 80 and 125 trades a year in the Options Income Blueprint service. We do an average of 1.5, maybe a little bit more weekly positions a week. We've been doing them more frequently lately because volatility is up. Here are a selection of recent trades, and these were winners. These are all the positions that we've opened and closed in the last few weeks, with one exception that's still open. And this is the kind of return you could get, assuming only one contract per trade. Just assuming just one contract. So not only, in fact, let me read that to you. Starbucks, big cap market leader, $65. Tesoro, independent refiner in the Pacific Northwest. They're actually announcing earnings next week. Blackstone, finest money manager in the world, arguably the largest publicly held private equity firm in the world. Southwest Airlines, you know. United Airlines, you know. Tesoro, again, I'll always play a stock to make you money. I'm not afraid of playing a stock 10 times in a year if it's going to make us money. Gilead, I just alluded to them, and Southwest Airlines. Now, it is not just my opinion. It is not just the option selling strategy, simple and repeatable, meaning that's my opinion. Other people agree with me. But it's so effective that 93% of my followers use it, make money with it. And if this all sounds too good to be true, sometimes it appears that way to me too, especially during these kinds of sessions. But one student of mine alone confirms that 98% of my weekly option trades do make money. And this is what can happen when you sell options week by week rather than buy them. Since I started with your service, I've made 97 trades, and 96 have been profitable. Thank you, Norman N. And this was an unsolicited email. That alone, to me, proves how successful you can be, and it's why I believe selling weekly options should be part of every single investor's toolbox. Remember, 0.5% a week is 25% a year, and you can perhaps do better. Now, I have 3 more weekly option trades I will want to walk you through before you leave. But before I do that, let me show you how you can get started immediately selling options for extra income every week. 4 years ago, when I started my Options Income Blueprint program to help investors, we put together a series of materials and a way of approaching people such as yourself. Why? Because you were facing a high-yield stock bubble, which we still have. There's virtually no return on cash investments, and there's falling yields on bond income. So I was already using weekly and monthly options. I still do, and that's how I came to create this service, because it's the only step-by-step plan designed to produce more income from your portfolio. So instead of then fooling around with 1.5% to 1% annual yields from traditional stocks, I'm now thinking you should take a system right in your hand, take control, and have a system that can generate 0.5% to 1% returns every week rather than every year. And that's why today I'm extending an invitation to help you begin paying yourself that extra weekly paycheck with my Options Income Blueprint, no hassle, 60-day test drive. So let me explain what's in it. You'll get immediate access to the Options Income Blueprint membership site. And in addition, you'll get the complete 5-module training video program and downloadable material when you become a member. In addition to it's a very extensive training program. If you want to take it, you take it at your own leisure. You'll also get all the options trade recommendations, which will tell you exactly what to do, which weekly options to sell, and how to maximize your income from them. And selling my option, in addition, you get the monthly option alerts, and you get a weekly update, which keeps you abreast of the market, of tactics, and of open positions. And you get my instant weekly paycheck winners. These are my view of the 25 favorite positions that you're looking to trade, or you should be looking to trade in the coming weeks, even if they're not an alert. Plus, you get 2 special reports, the new buzz, Trading Weekly Options for Income. It's another tool for helping you sell weekly options to generate the extra payday we've all been talking about, and how to become a put-selling pro. Selling puts week after week is the way the pros play stocks, and this report will give you some great tips for trading weekly puts inexpensively and for income, cash, and profit. And you'll get everything 60 days, everything, meaning there's no restrictions just because it's a 60-day trial for just $79. Now, you can choose to go it alone. You know, you may be doing this, you may have just been eavesdropping. You can do this on your own for your option trades, but if you really want to get off to the best start possible, to put that first weekly paycheck in the bank in your account, take me up in this offer for Options Income Blueprint. It should be the best $79 you ever spend to master a very, very simple option selling trading strategy, and it should pay you back every week, hopefully for the rest of your life. And I think John will take it from here with a couple more specifics. John?
And then I'll bring you back in so you can cover those last 3 trades that you want to share with everybody, and we'll also start doing the Q&A. So again, folks, if you have questions, please feel free to load them up in the chat box, and we will come back to answering them, and stick around and answer as many of those questions as you have. But this is the 4-year track record of the Options Income Blueprint program, and as you can see, it is consistent in its results. Now, I want to make something very, very clear before the skeptics start complaining. The 98 or 96 or 99% winning trades does not mean that the 1% trade that didn't make money wiped out all of the gains from the other 98% trades. It didn't happen. It doesn't happen. Now, we've standardized based on our membership base, based on the number of contracts, the average number of contracts that our members currently sell when they take a position that Michael recommends. That average is 3 contracts per trade. Now, that means that most of our members have a larger capital base. I want to make that clear so that you understand that. Just because you don't have a larger capital base does not mean that you can't produce income for yourself using the Options Income Blueprint strategy. Nothing could be further from the truth. So if you want, simply divide by 3 those dollar amounts that you see on your screen right now, and that would be the average for one contract per trade. So if you think about it, that's anywhere from $6,000 to $10,000 per year in additional income you can generate from yourself, even if you have a smaller portfolio, even if you're struggling to produce income from high-yield stocks, from bonds, from CDs, from annuities, from savings accounts. And if you look at the statistics, the true statistics, all of those have crashed, and have crashed far worse than the stock market did. The stock market recovered, and Michael will tell you why the stock market has recovered and why yields and interest rates are going to remain depressed. I said depressed for the next 5 to 10 years. So if you're looking to try to get balanced portfolio, you will always be falling very far short on traditionally safe investments, U.S. Treasuries, CDs, savings accounts. All of those were traditionally safe investments, and yet their yields and interest rates are 86 to 50% lower than they were 5 years ago. That's not going to change in the next 5 years. So you, as an income investor, or as somebody who wants to produce income from yourself, must do something. You cannot simply continue to do the same thing you've been doing for the last 10 to 15 years. The definition of insanity, according to Einstein, is doing the same thing again and again and expecting a different result. So it's time to do something different, and that something different is the Options Income Blueprint. Now again, over the last 4 years, Michael has been helping investors achieve this kind of track record, this consistency in winning trades over the course of the year. As he said, he produces between 80 and 130 trade recommendations during the course of the year. Market conditions will determine how many trades he's making. Those trades are a mixture of weeklies and monthlies, so you are selling weekly options and or selling monthly options simultaneously sometimes. But as part of this program, as part of the test drive, and we're going to let you have a chance to get in right now, let me go through once again exactly what's included in the test drive, piece by piece. So as we go to the next slide here, you can see exactly what you're getting as a member of the Options Income Blueprint, which is on the next slide. There we are. So here, your 60-day trial, as Michael said, you get access to everything. Just because you're coming in to test this, remember, the reason we do this as a trial, there are 2 core reasons. The first is you may not know Michael. If you don't know him, you've never traded with him, you need to understand how he thinks about the market. And he's actually going to share a little bit about that in just a couple of moments with you. But more importantly, you need to build a little bit of trust in understanding how he produces his trade recommendations. You need to see that those trade recommendations actually produce income from you. And the second part is because you have to make sure that this program is right for you. It's not for everyone. We know that. But the only way for you to know if it's right for yourself is to do it. And then once you get in and you start generating that weekly paycheck, once you start closing those weekly trades, once you start getting those trades to expire worthless and you're keeping all that cash, I don't think you'll go anywhere. But let me tell you again, what you get as part of this, you get Michael's best options trade recommendations every single week of the year. Now again, those will be a mixture of monthlies and weeklies. He typically focuses on the weekly options every week, usually around Wednesdays. For those who are time limited, the weekly trade recommendations are typically put out around 11 a.m. or noon Eastern time, so you have more than enough time to execute the trade. And then typically those trades will close on Friday, so you're only in those trades for a couple of days. Now that's important from capital management because when you are selling a put, as Michael explained, you are using your capital as collateral on that put. It's essentially a cash secured put. But your capital is only tied up, if you will, for 2 days. Now, once Friday comes along and you close that trade, guess what? You now have freed up your capital for the next week's trades. And the same is true with monthly trades. As he places monthly trades, your capital is tied up for a brief period of time. And as he showed you with the Gilead trade, about 10 days elapsed, you were able to cash out with $175 per contract, and then your capital was freed up to make the next trade. So you'll be getting those trade recommendations every single week as a member of the Options Income Blueprint program. You'll also get the member site, which has everything you need in one simple place. That includes the 5-module Selling Options for Income trading program, or training program, excuse me. And in each of those modules, Michael will teach you from essentially start to finish how to set up your portfolio so you understand how to use it to maximize the amount of income you will make. You'll learn exactly the difference between selling puts and selling covered calls. Both are covered in the training program. You'll learn exactly how to sell a weekly option. You'll also learn how to use index ETFs and other opportunities in addition to stocks. So other indexes that have weekly options and/or monthly options are also accessible to you. In addition to the 5-module training program, as he said, you also get 3 bonus video lessons and the 3 bonus reports. He covered those for you. And about every 6 weeks, Michael brings all of his members together for a live coaching and strategy session. Now, this is an opportunity for all of his members to ask questions, to get the help that they need in ensuring that they're following the program, following the trades, maximizing their income from their portfolio. And we do that about every 6 weeks. So just as you're here today, it's an environment very similar to this. It's an opportunity for you to interact on a one-to-one basis with Michael as part of the membership base. We currently have over 900 members in the program, so there's space for a few more, and we'll get down to that in just a couple of minutes. But you also get, and probably one of the best little features, is what we call instant answer email support. So that's an opportunity for you to send email directly to Michael to get the help that you need when you need it. Your email isn't going through customer service. There isn't a long delay, like 2-3 days to get an answer. It's instant answer. So you can get an answer usually within an hour during business hours, 9 a.m. to 5 p.m. Monday through Friday. So all of that is included in your 60-day test drive. The price on the test drive, again, is $79. And within the first few weeks of this program, you'll be able to pay that back. And you will see, you saw with just the one trade, Gilead, that was shown, $175. So you will already have produced a return on investment, and you can do it that quickly. So again, $79. Now there's a pop-in box to the right of your screen next to the chat, which will give you an instant link to get in to reserve your space. We only have a few spaces left for February. So if you're struggling to produce income from your portfolio, now is the time to do this. Start learning with Michael right away. You'll be able to get your first weekly trades next week, and by next Friday, you'll be able to close those trades for cash gains in your account. Now, again, the price is $79 for the 60-day trial. If you decide, when you decide to continue on, it'll be $79 a month each month thereafter. You can stay in as long as you want. You can also have an opportunity to become an annual member and stick around with us for a very long time. We have many of our membership which has been with Michael since inception. So that should give you about 25% of our members have been with us for the last 4 years. So that should give you the confidence to know that there is a base of people here who have been doing this for 4 consecutive years. That's how powerful this program is, and it's simple. Now, we have a lot of questions that we want to answer, private and public questions that we'll get back to here in just a moment. But Michael, I know you had 3 more trades that you wanted to walk people through, so let's walk them through those trades so that they can see what's possible, and then we'll come back and we'll finish up with the Q&A session.
Sure, and I'll keep it brief because I know many of you have things to do or you want to go some questions, but I wanted to give you a more granular feel of what we do. Tesoro is an independent refiner in the Pacific Northwest, in the Midwest, and they, about less than 2 years ago, bought a refinery that they've made much more efficient in Southern California. I do fundamental research. Most, when you hear the word trading service, they work backward from charts. I work with trends. The trends go to the sectors go to the best companies, the companies then go to the best stocks, and the stocks then go to the best option characteristics that are appropriate to trade in a given week or a given month. Tesoro is one of them. I discovered it a while ago, maybe a year, 14 months ago, in the 50s. It's now trading at $85. So I like where it was trading, and this is a condensed version of an alert, but this is cut and paste job, so this is real, what you really would see. There's more description of the company in the real alert. And the alert went out, and it was to sell the January week $270 puts expiring in a couple of days. And here's the recap. This is based on a fundamental belief that the world was waking up that when you dump energy ETFs, some great companies were dumped that were lumped into the ETF, or energy funds. Tesoro is one of them, and it's, you see, Tesoro's operating margins are expanding every quarter because they're using more fracked oil and less Gulf oil, and they're very proximate to the fracking fields in North Dakota, and that means their operating margins are expanding. And in the refining business, the only thing guys on Wall Street care about are operating margins, which they actually call the spread. It was trading at $72.60. We sold the $70 put. We collected $45 per contract. $7,000 in capital was required. TSO closed itself. There was no commission. And we had a $45 paycheck. If you'd done 3 of these, you would have had a $135 paycheck. Fundamentals to charts, deep understanding, and actually a very big cushion. $2.60 between the stock price and the strike price of the put, and there were no catalysts to be seen. But this was created by the volatility associated with the churn in oil prices in the oil sector and a misunderstanding of the stock on Wall Street. Next one's a company, many of you have probably flown with them, and that's Southwest Airlines. Airlines, of course, are benefiting from the decline in oil prices. I've traded 4, United, Delta, American, and Southwest. Southwest was in a bit of a lull because Wall Street knew that they hedged a lot of their jet fuel going forward, but the hedges are coming off, meaning that their fuel prices are coming down. We went and we sold the puts, and these are classic week trades. These are 2-3 days, and it was trading at 41.80. We sold the week 4 $40 puts. We collected $30 a contract, and only $4,000 in capital was required per contract. Closed at 45.78, and we kept the 30. If you've done 3 contracts, that's a $90 paycheck. A very, very excellent rate of return. And when you're looking at, especially if you're a hardcore options buyer and you're attending, you have to take a look at this from a different perspective of we're trying to get 0.5% to 1% a week, which is 25% or more a year. And it's this constant banging away at these hyper-efficient, flexible trades. Now, the last one is a good one to show you about flexibility, because this was a monthly position to sell Starbucks puts almost a month in advance. Expiration this month is February 20th, and this was on January 23rd. So this is what the alert looked like. And the targeted return was, and that 50 times a year, by the way, is incorrect. This was a draft that did not go out. This is from my hard drive when I put this together. But this is what it looked like in terms of $175 per contract. It's all spelled out. All of this is spelled out for you in the alert should you become a subscriber. There's nothing that's ambiguous, including the projected rate of return, which should have said 12 times a year. Again, I pulled my draft. I didn't pull this off the member website. But what happens? Now look at the dates. The date here was January 23rd. The stock moved abruptly, and a lot of the option just disappeared in value, which really messes up the buyer. But we're not the buyer. We sold it. So we had $1.75 in hand. I said to buy it back at $1.10. We freed up capital for the next trade. We collected $65 in per contract net profit, and the annualized return was 37.5%. Now we do absolute returns. Here it's 0.75%, and we do an annualized return so members can compare how they're doing transaction to transaction. I provide both to you. So the point of this is to show we're flexible, and because of volatility, we've closed out. I closed out Halliburton yesterday, which was a monthly trade. We closed out Tesoro and Whole Foods Market last week. We've been closing out our monthly positions. The monthlies give you a bigger chunk of cash, like the Gilead trade earlier, a much larger chunk of cash, a lot more flexibility, and if you see that you can close it in a week and move your capital to another opportunity, we do so. So those are the 3 extra trades I wanted to show you, and let's bring it back to John.
Actually, Michael, can you back up one slide? I want to point out 4 things on this. As we talked about earlier in the presentation, we told you, and Michael shared with you, what the advantages are of selling options. And the first advantage was instant cash. So if you had made this trade, apologies for the if, but if you had made this trade, you collected $175 per contract. Your capital requirement would have been $8,750 to sell 1 contract. So 1 contract with $175 instant cash. That cash is in your account now. Now remember that we told you now you're transferring risk to the buyer. The buyer is accepting that risk, that in essence that the stock will go up and not go down, and that's exactly what happened. That's why the seller has such a powerful advantage here. When Starbucks made that next move up, the buyer was out of luck. The seller was in the money, so to speak. So the key here, however, is that we told you in that last bullet point that the seller of the option is managing money they've already made. Listen to that again. As a seller of options, you are managing money you've already made. The buyer has to manage risk in the trade. You are managing profit you've already collected. So in this example, the point that Michael was making was you had $65 in hand. So it's the bird in the hand, better than two in the bush kind of concept here, but it was also an ability within just a few days, 5 days, to free up capital to be used on another trading event. So within 5 days, you had $65 per contract. You were in, you were out, you had a successful trade, you made money, that you made instant income, you met all of the requirements for being an income trader. So that's why we've put this together as a 60-day test drive so that you can come in, discover how to do this for yourself, learn how to do it with Michael. Let Michael do the hard work first in finding the companies for you that offer the best opportunities for income each week. Remember, this is a weekly program. This is an opportunity for you to put cash in your account every single week, 52 times a year. He's talking about giving you a 25% annualized return on your capital. That's hard to do, and yet he's provided exactly that for the last 4 years. So once again, in the link is now in the admin notice box up above it in the chat. It's also in the chat. I'll put it up again a little later on, and it's also in the pop-in box so that you can reserve your seat right now. You should do this. You should learn how to do this. As I made notice to a couple of folks in their private questions, you do have to have at least $10,000 in order to sell options effectively. And that's largely because, as you've seen with a couple of these stocks, they have larger strike price. They have larger options prices, stock prices, so that increases the amount of capital you need just to sell one contract. The larger your capital base, the more freedom and flexibility you have in managing and putting on multiple positions each week and from month to month. So this, as you will discover, if you have $50 or $100 or $250,000 or more, you will find that selling options is probably the best tool in your little toolbox to be using to produce income from yourself. So with that, Michael, we'll start doing some of the question and answer here. And let me, if you want to bring up the last slide so that everybody can review for themselves what's available in the program, we will do that and leave that up. And let's see here. Let's a question from a no-name person here. What is generally the minimum amount of premium that you look to get when you place a trade?
It's a very good question. Actually, you're one of the first people to ask that. I usually think in terms of rates of return, but there's a practical consideration here, which are commissions, especially if it's a low-price stock. My minimum rate of return, let's start with that, is usually about 25% a year, and that would be the low range. So if I specified you're going to try to get 50 cents or $50 a contract, I will say go as low as 40 or go as low as 45 or go as low as 35, and the bottom end of that is usually in the mid-20s, maybe a little bit lower, but often the mid-20s. The absolute cash amount, it's hard for me to, I occasionally have sold something for 20 cents, but usually you're looking at $30 a contract or more is the much more, the low end of the range, the very low end. If you're thinking dollars and not rates of return, because of commissions and knowing that there's a very disparate subscriber base, people who may do 2 contracts, people who may do 20, I have to be mindful of it in terms of serving everybody. So I'd say if I went through all the alerts that I issued last year, the lowest would be 30, and it would be on a low price stock where I'm assuming people will do multiple contracts.
Thank you, Michael. And just a little clarification to help Louise. She's approved up to level 2. What level account as an options trader do you typically need to have?
That depends on your broker. Everybody, remember, this is not an SEC regulation. This is not even an exchange regulation. There are guidelines in exchanges. It's all up to your broker. I don't even know what mine is. I filled out the paperwork so long ago. It was probably 5 or 10 years ago. I know when I did it with a traditional terrestrial broker, which at the time was Morgan Stanley, I had to fill out 6 forms, and it took 3 days. When I did it online with an online broker, it took 5 minutes. So it all depends. I would contact your broker. These are all cash. This is all cash secured. You're not speculating. So the bottom line is, I'm assuming it would be, for those of you who are familiar with the term, I'm guessing it'd be level 2, maybe level 3. But I don't. It really depends on your broker.
And then a double question here from Mark, which I'll let you answer in 2 different ways. And I'm going to paraphrase it and change it around a little bit. First of all, what is your process for identifying a trade and for making the trade? And second, as part of that, and probably combine some of the other questions here, when a trade moves against you, what is that one tactic you use?
Oh, good. 2 good questions. The process is, as I alluded to very quickly, because we don't have a lot of time. This is all based on stock picking. It starts with stock picking, and for those of you who are sort of laughing because we're talking about trading, it starts with company fundamentals. And the reason is that right now, and I'm not exaggerating, you can look it up, their data sources, we have the most divergence of individual stocks from the movement of the indices in a generation, and since 1991 or 1990. What that means is that there's a near 50% probability or more that an individual stock will move out of sync with an index in a given period of time. We're in a stock picker's market, and I've always been a stock picker, so this is my kind of market. The second thing is you go from there. I have a core of 25 stocks with 50 adjuncts that I change every quarter for myself, and I follow them. And I understand them, I understand the company, I know when the events are, and I know how the stock is moving. And when it gets down to the hardcore stuff, which is which trade to pick, I know what trading ranges they're in, and as I've said before, again, I alluded to this, I use the 3, 5, and 10-day, and occasionally the 30-day volume flows into a stock, meaning where the volume of trading activity picks up on the 3-day, the 5-day, the 10-day, and the 30-day when I'm doing a weekly option. When you're doing a monthly and it's a few weeks out, you have to add into that the 50 and the 200-day moving averages. Because you want to sell a put, obviously, when it's something is bouncing off its 50 or its 200, but that doesn't necessarily hold over a 2.5-day period of time. So the volume support levels are very fine. So you start going from trend to sector to company to stock to option characteristics, which means got to have at least that 25 to 40% transaction return on an annualized basis, a 0.5 to 1% on the transaction itself, and then you take a look at the charts and so forth and so on. Now the tactic I mentioned is I'm using a term right off of my broker screen. On my broker, when I look at an options position, it says trade, chain, chart, and roll, and we call it rolling. And what it would mean is, let's say you sold a put on a $30 stock. You sold the $28 put, and the stock goes to $27.50, and you don't want to be put the shares. If it's a weekly, we usually do this in the middle from 10 o'clock to 12 o'clock on Friday. You roll it. You buy back the original put, and you sell one for the next week, or if you want to get yourself a cushion of time, you sell it for the next month. We do it with more frequency overall in the service with monthlies than we do with weeklies. In 2013, it was 15% of positions were rolled. Last year, it was 20 or 21, but it was below. It was in single digits for weeklies, and almost all of those were closed within 5 trading days. Meaning, right now we have a SanDisk roll on that I could close at break even. What I want to do is I want to wait till it makes money. As long as we're in the trade, we might as well try to make money, and I think we will because there's a lot of time value that's eroding. This is something I've been doing for 4 years. It is very what I call position oriented rather than transaction oriented. So if I have to extend one transaction into another, I call it a position, and the idea is to make a really good profit from the position and not to fret over one specific transaction. There's a special, it's embedded in the training program, but there's also a special video on this just because some of this is a very new concept. And even on my broker screen, which says roll, when you click on it to make the trade, on the top it says spread. So theoretically, this is what people would call a spread, but it's really just rolling from one week to another, or from 1 month to another, or from 1 week to another month. And it works. We did 85 positions last year that were open and closed in the same year. We did more trades than that, but open and closed in the same year. 83 were closed with a profit. Two, and they were on the same company, Creed, because I had put out an alert before earnings. I'd warned people, if I'm wrong about earnings, this could go south, and it did go south. And I only do about 3 or 4 earnings trades a year, maybe 5. And we've rolled it. We've rolled it. We accepted shares. We're selling calls. We'll be break even very, very soon. So that's a rarity. Most of the times when we roll, we're out in a few days. It's a long-standing tactic with a 4-year track record that significantly outperforms any other type of tactic in terms of minimizing your risk.
Thank you. And let me pull a couple here. Donovan asked, does selling options require buying the stock as well? No, it does not.
If you're selling a call, but not if you're selling a put.
Sorry, thank you. Well, since we're largely focused on selling puts,
yes.
What would be the optimal commission rate in order to make trading weekly options feasible? Really, all of that depends on the total amount of capital, because if you're selling multiple contracts, then obviously your commissions are less of a factor because you have more capital to work with. If you have less capital, you want to go for the lowest possible commission broker you can find. And if I remember correctly, Interactive Brokers is somewhere around $1.50 or $1.95 for options trades. Most of the other brokers are
plus per contract. The plus is a per contract fee.
Per contract. So,
John, if I may, one of the things about the live strategy sessions is this question always comes up from new members, and everybody starts typing in the chat box what they're paying and where they're paying it. So there's a whole community of interest around this topic, and John's correct. I think that Interactive is the least expensive. I'm an idiot. I use the most expensive, which is Options Express. But I love the ergonomics. They're rated the best in the business. And because of what I do, the ergonomics are more important than anything. And I get a big discount because I'm a frequent trader. But so there's a whole range depending upon what your preferences are.
So Bill asked, actually, oh, I see. Bill corrected his question as well. Do you sell puts in the money or out of the money? Is there one that is better than the other?
In the history of the service, I've sold one put in the money. It was Bank of America. I sold an $8 put when the stock was $7.90. Of course, the stock went up to $17, so I considered it a really good trade. That was about 3.5 years ago. And I told people that we were going to accept shares, meaning the trade was right up front. You don't want to own shares, don't make this trade. I'm hoping you'll be put to stock. We have found through surveys and through watching trading action, most of our members don't want to own shares, even if it's a good idea, and prefer puts. So we've phased buying shares and selling calls out of the service. We've just recently had a renewed interest in doing this. So I've started to look at call positions, meaning I'd recommend buying the stock and selling the call, and it may, and this is the word is may, it may mean selling with a broad, paragraph right at the front of the alert going, only make this trade if you want to own the shares. In that case, we would sell it in the money put. I do advanced coaching services where we sell in the money puts and in the money calls all the time. But this is a core basic service where we want to keep things very, very easy to transact. Not limiting money in any way, limiting profit, but we want a simplicity to the execution, both for weeklies and for monthlies. And in the money puts emotionally turns people off, and we found our subscribers wouldn't want to do them, so we don't.
Thank you. Harvey followed on with Louise's question. I believe you would need to get approved for a high level of options trading to trade naked puts. You're not trading naked puts. Remember, you're trading a cash secured put. That means you have the collateral on hand to accept assignment of shares in the more often than not unlikely event that you are put the stock. Now remember, as Michael explained in the rolling strategy, it's the one tactic he's used over the last 4 years to prevent losing trades. It is the tactic that also prevents you from being put the stock, or it helps you prevent being put the
John,
stock.
if I may, let me give a really good example to rolling, because this is an important question. Forgive me for interrupting. I had recommended American Airlines put, and a day later, the Ukrainian Russians murdered all the people on the Malaysian airline. They brought it down. And reflexively, the lemmings on Wall Street sold off all the airline stocks. Because of an accident, a murder in the Ukraine, everybody was never going to fly again. So all the stocks went down. So, of course, I had to roll the American Airlines shares. But extreme volatility occurred. And rather than roll from week to week, I used it as a profit-seeking opportunity. And I rolled to the next month, meaning extended the trade for 3 weeks because the premiums were just gigantic. Now, the original target for that trade was about 0.6%. We closed the trade the following Wednesday because the stock, of course, immediately bounced back when the guys on Wall Street like went and had their cup of coffee at Starbucks or something. And the bottom line was that trade we made over a percentage point in the same weekly time period, Wednesday to Wednesday. So it ended up having a huge annualized return. I think it was a 1.2% absolute return in 5 or 6 days. And there's an example of how you use rolling to your benefit and preventing you from being put to shares. If you didn't roll, and this is a very important point, you would have been put to shares and actually would have made a lot of money the next week anyway. If you'd had a spread, you might have been blown out of the water because of the sharpness of the move. And so depending upon how you constructed it. So I know I get questions, why don't you do spreads? There's nothing wrong with them. I do them in my advanced services. I do them in my own portfolio. I do simple ones, but I still do them. But not in this service. Rolling works better because you're trying to protect core capital. And with spreads, occasionally you have to take a loss just to move on. And you don't in my service. And you typically, I mean, someday it might happen, but just like the disclaimer. But the idea is never to take a hit to your capital. And
as well with the spread trade, you're also limiting your profit potential, are you not?
Oh, absolutely, absolutely.
Thank you, Michael. Let's see, Edwin. Welcome back, Edwin. Edwin says he was previously a member and he wants to get back in. Well, get back in, Edwin. We're glad to have you back, sir. What aspects of technical analysis, if any, do you use?
I use two things for weeklies. It's none of the Greeks. It's none of the moving averages. I mean, because I follow the stocks, I obviously know where the moving averages are. But the thing that works, and this is only proven through history. You're not going to get it in any trading textbook, and you're not going to get it on one of these geek sites where the guys speak in Greek. It's the 3, the 5, the 10, and to a lesser extent the 30-day volume flows of money into a stock. When you're doing a 2.5 or 3 or 3.5 day or 2-day position, that's what matters. It's where money is going to come in, and speaking sort of at a very primitive level, it's where the bulls and the bears are going to argue for a period of time about what's the right price for the stock, which is what you're looking for. Now, if I do a monthly, even if I'm planning on closing it early, of course I look at moving averages. I know the technical traders like the short-term 10 and 20s. I use 50 and 200. They're more durable. They just work better in this kind of a system. In the training program, there's an entire discussion of implied volatility, and which is a Greek. Let's not get there. There's a whole discussion of the optimal, because the training program covers calls. It's not just puts. And it's a 5 or 6 hour training program in 1 hour modules in addition to the specialized modules. So there's a whole thing on preferred volatility ranges for selling calls and for selling puts. And I don't remember exactly what they were because volatility was much higher at the time. But it's usually anything above a 55. An implied volatility would be too difficult to manage. And anything below 20 or 25, you're not going to get the premium that you want. And there's about a 10-point difference calls to puts. You can tolerate higher implied volatility with puts, but I don't use them. I'm trying to show you that I know all these things, and I've willfully discarded using them because looking at volume support on weeklies is much more effective. And just to recap on monthlies, I do look at moving averages.
Mark says you are not entirely being honest on the risk to the seller of the option. If you cannot roll and stock tanks, you have a problem.
What do you mean if you cannot roll? You can always roll unless this company goes bankrupt. So forget the firm pushback. When you sell a put, you'll see it in the alert. You have to be willing to own the shares at the price of the strike. That is no different than purchasing a stock. There is no more risk in selling a put on a stock for $30 than owning that stock at $30 a share. That is the only risk judgment you need to make. So to the extent that you are putting on a put position, it's right there in the alert. To get into the position, you must be willing to own the shares at the price of the strike price, which is no different than the decision you would make. I want to buy Apple at 110. I want to buy Gilead at 85. I want to buy Tesoro at 60. There's no difference. And the flip side is, and the reason I reacted so strongly, you can always roll a position, barring the company going out of business or a stock going from $60 to $5. And that just doesn't happen. And let me give you an example. Last year, there was a company called GTAT Technologies that was supposed to supply sapphire glass to Apple. And it was very speculative, yada, yada, yada. We traded it once. and we got out before the Apple iPhone 6 announcement because no one was sure that what would happen. Would they have a high percentage of sapphire glass in the iPhone 6? There was no way I was going to expose subscribers to that kind of announcement. Turns out there was none because GTAT couldn't get their factory to work, and they voluntarily declared bankruptcy like a week or two later, and the stock went from 15 to 45 cents. I don't trade around events. I don't trade biotech stocks. I don't go anywhere near that kind of speculative possibility for the reason you just asked, because the core to generating income is preserving capital. That's the most important thing. There's nothing more important than preserving your capital base, because if it shrinks, then the base for your generating income shrinks. So the first rule of thumb is do no harm. And to that extent, the stock selection is I always look at what the role would be before I put on a trade. And that's in the training program as well. It's something I emphasize in my coaching programs. You have to look at the recovery position. For example, let's say you want to do weekly trades and it's the third week of the month, right? And I recommend something, well, it's expensive stock, but like Illumina, which is 190 a share, but it doesn't have weeklies. I put in the alert, if you only want to tie your money up for a few days and we have to roll this, you can only roll into the next month. There's no weekly available next week. So you look at recovery possibilities. I do. You should, before you put on a position. But it has never happened, ever. We probably made at least 500 trades in the service, probably more, that we weren't unable to roll a position if we wanted to. It's never occurred.
All right, Mark. Thanks for the question, and again, we welcome the skepticism. We know that it's hard to believe when somebody has a good track record. It's hard to believe that you can actually do this and not run the risk of blowing up your portfolio. But I want to give you folks something that I don't usually give you, and so Michael, this is follow my lead, as we talked about in our email before we got started here. I would like you to give people a little insight into how you talked about this being a stock picker's market, but can you dive a little bit into one or two trends, the process that you go through?
Sure.
I mean, oil is an obvious one that everybody would be thinking about.
No, let's do something less than obvious. There's a couple of trends. I do trends, and because we're not on Wall Street, and need to think a little bit more creatively. We do trends that cut across traditional sectors. So I'll talk about a trend called iWorld, which is the simple basis of it is the company that offers the best the widest selection of choices in products or services, or the most customized products and services for the sector they're serving wins. This explains the success of Panera, Chipotle. Do you know in Buffalo Wild Wings, if you multiply everything on the menu and then by the beers and then by the desserts and then by the TV screens, you have 2.4 million choices for your meal? I'm not kidding. Chipotle, I think it's 800,000 or 600,000. And it's something that you don't necessarily quantify. Well, that's how I look at things. So from iWorld came something called first 4 or 5 years ago came the New American Grocery Store, which was Dollar General, and the next became the New American Kitchen, which is Williams-Sonoma. And let me focus on Williams-Sonoma for a moment. Williams-Sonoma has always been seen as a high-end retailer for foo-foo people buying copper pots. Well, nothing could be further from the truth. First of all, you have to go to the stores, which I do. I do at least one shopping mall a week when I'm examining retail. What happens is there's been a food revolution in the United States led by millennials, actually, and people into sustainability, into organic, and all that kind of thing. And what has happened is people have discovered that good food prepared at home tastes better, even if it's more expensive, and that you need to buy stuff to cook it. And you want to buy better stuff because now it's something important to you compared to what it was a year ago. So what happened is Williams-Sonoma's natural market of customers expanded from the top 10 to 15% of income earners and maybe the top 30% of income earners giving a gift. It has expanded to the top 1/3 to 1/2 of the population. Wall Street completely missed this. But if you look at iWorld and you look at the New American Kitchen and you look at millennials wanting the most possible, not just millennials, now everybody, looking at the greatest number of possible food choices, you need implements to do that. So the whole thinking leads you to a company, and then you investigate the company, you look at the stock, you look at the movement, you look at earnings, you look at the option characteristics. So in that category, there's Hain, symbol HIN, there's Whole Foods Market, symbol WFM, there's Williams-Sonoma, symbol WSM. There's a company that is more speculative, and that's a home delivery national service called Grubhub, symbol GRUB, which you should not go near their earnings, because if they miss, they have a very high multiple. The stock's going to get hurt. And they've only been public for about 15 or 18 months, but the options are pretty good. So you look at these things, and that's how a trend brings you down into a stock. You have to think creatively, because remember, the stock picking here. Let me give you an example. In October, when the oil market first started to really crack, the indices sold off. One of them was like 6.7% or 5.7%. Except for a couple of monthlies we rolled, we made money on all our weeklies. That explains the flexibility, of a 2.5, 3-day position. But more importantly, it showed stock picking works even in the face of declining indexes. We had stocks that were going up, and I'm not talking about the airlines. We were trading stocks that didn't budge, and in fact went up. But when the overall market started to have more volatility, these stocks started to swing back maybe a little bit more intraday. Therefore, the premiums went up on the options, and therefore you could sell a put a little bit further away from the strike, the stock being a little bit away from the strike price. So that kind of index down action actually increased our profitability and made stock picking easier. I know it's counterintuitive, but when you start with trends and you select your stocks, as I said, there's 25 in what I call my bullpen, and I share them in the update, by the way. I do this trend stuff in the updates every so often and give you a list of stocks that I may not be trading, but you should be looking at, because it's a whole purpose service. It's not just alerts. And then there's another 50 I'm always keeping in touch with. And so, to John's point, stock picking is at the core of this. And I know the next question is going to be asked, what do you do during a correction? Sharpest correction we've all had in the last few years, besides the oil correction in October, was the summer of 2011. Greece was melting and Congress lost its mind. Well, some part of Congress lost its mind, shut down the government. At that time, they were threatening to renege on the national debt. We never made more money. Just never even came close to making more money than we have then, because it's easy to trade a geopolitical crisis. If it's currency, you're going to trade currency ETFs, and you're going to trade precious metals. You're going to sell puts on them. We even traded puts on bond funds, because even though they were threatening to renege on debt, everybody was buying treasuries because they didn't know what to do with their money. So we were just one trade. We would close them out in a day or two. We would sell a monthly and close it out in 2 or 3 days. And this went on for about 6 weeks. So the flexibility that short-term positions have, based on a fundamental view of the world with the geopolitical events, or a fundamental view of a company, a Williams-Sonoma, that is picking. You're not playing averages. You're not playing charts exclusively. You're not starting with charts. You're starting with the real world. And one last point, John. I ran a short service for many years, and I'm bragging now. I predicted the housing and the banking crash in February of 2007, which was a year before it became manifest to a lot of people. And at one time, it was a purely speculative service. It was all buying puts, and with money doubler after money doubler after money doubler after money doubler. And so I'm familiar with that. And I personally didn't get back into the market till years after QE started, but I am now a secular bull. The United States is the world's largest agricultural producer, the world's largest energy producer, the world's largest manufacturer, the world's, by an order of magnitude, the world's largest R&D outfit, the world's largest producer of people with higher education, the world's largest consumer sector, the world's largest financial sector by several gigantic trillions of dollars. And we're in a stronger economic position than we've been compared to the rest of the world in a generation. And that means a lot to investors. And with the dollar rising, it means if you're European and you buy an American stock and your own currency goes down, as your currency goes down, the value of your stock goes up. So the stars are in alignment here for a foundational support from the real world against technical trading that may push the market down. Could we have a correction? Sure. But the bottom line is the corrections are going to be short. We had 6.5% in October. Maybe we have a 6 to 10% sometime this year. But I look forward to them. I welcome them because they create the volatility that gives us more premium on the puts we sell.
Thanks, Michael. And Louise, just dropping a quick email in chat reply to you here. So I think we're pretty well caught up on all of our questions, and you actually took care of Steve's question about what happens in a bear market. So Louise, I'm going to send you my a quick reply, so just hang out for about 8 more seconds, and I'll get that to you. And after that, I think, Michael, we're in good shape. If you would, Michael, back up to the slide that shows the 4-year track record. There were a few people who missed that slide, just so they can see what was possible in each of those years. Yep, that's the one right there. So 2011, 12, 13, 14, you can see the consistency in the winning percentage. And I'm trying to type while I talk, which is like not happening. So hang on here, folks. Sorry about that. All right, Louise, there you are. My reply to you is in the chat box real quick there. So again, the consistency, what you just listened to, and the reason that I asked Michael to do that was to give you a little insight into how he approaches the market. It is different than what most people are accustomed to. If you look at the chat box questions, you'll see people asking things about technical analysis, delta this, Greek that, etc. He has simplified his process to start with fundamental analysis. Fundamentals drive technicals. If you learn anything from this webinar, learn that. The fundamentals of a company drive the technicals of the chart. So he starts with fundamentals because you either have a good company or you have a bad company. And if you have a good company, now you're on to something. Now you have something to start working with. And that's the process he just took you through, how he looks at a trend, how he identifies the best potential companies to use within that trend, and then how he looks and actually talked about how to maybe move some of the ones that are a little too speculative out of the way so that you don't put your capital at risk. So capital preservation is number 1, instant cash is number 2, having the right stocks to trade, having the right person to help you find the right stocks to trade is the biggest benefit to being a member of the Options Income Blueprint program, and you will not find a better stock picker over the last 4 years than you will with Michael Schulman in the Options Income Blueprint program. Now, a couple of questions came in privately. How come your track record is only 4 years? Because weekly options have only been available for retail investors to use over the last 4 years. So the universe was very, very small at the start, and it has grown substantially since 2010, 2011, when we first began this program. So that's going to be a wrap up, and Louise will try to get in touch with you shortly. Thank you very much. For everybody else, thanks for taking time to join us. Michael, any last second thoughts on the market today?
No, not really. I think, yeah, the market today, it's yes, because you mentioned the technicals in the box, I'm trying to figure out how to say this. Traders used to own the market, and in the summer of 2012, investors took over. And it's an enormous change. And the sell-offs that we've seen based on technicals, like yesterday, the ECB said, we're not going to honor Greek debt anymore. That's an oversimplification. The market sold off 100 points. It was up 100 points at the open today. Traders cannot beat back investors. We are here, and keep this in mind as I hang up, we have an investment mentality, but we're trading every week for income with our investors' hat on, but we're trading. We're using the best of both worlds. And the investors have beaten back the traders now for 2.5 years and will continue to do so.
And there you are. That's the last word. That will wrap up our webinar for today. This recording will be available to you. Excuse me, this was recorded while we were doing it live. It will be available to you very, very shortly here, and we will also email it to you. The deadline to get in for February is going to be Sunday, or the last 21 seats, since we had 17 new people join us this afternoon. Michael, thank you for your time. For all of you who attended and listened and asked great questions, we would like to thank you for participating and for asking great questions, even some of the tough ones that were out there. So thanks to Mark and Steve and Bill and Louise and everybody else who asked, again, some terrific questions. We do appreciate it, and thank you for the opportunity to share this process with you and share our little training process with you, if you will. We look forward to working with those of you who have joined. Edwin, it's great to have you back, sir. And we will look forward to working with the rest of you, if not today, then in the near future. For everyone here at Traders Reserve's Options Income Blueprint, and for Michael Schulman, my name is John Hutchinson. Have an excellent day, and thank you again for your time.